Welcome to Thoughts on the Market. I'm Seth Carpenter, Morgan Stanley's global chief economist, and today we're going to be talking about tariffs and what they mean for the global economy. It's Monday, April 7th at 10 a.m. in New York.
And it's 4 p.m. in Frankfurt.
And it's 10 p.m. in Hong Kong.
And so I'm here with our global economists from around the world. Mike Gapin, chief U.S. economist, Chetan Ayya, our chief Asia economist, and Jens Eisenschmidt, our chief Europe economist. So let's jump into it. Let me go around first and ask each of you, what is the top question that you are getting from investors around the world? Chetan.
Tariffs.
Jens.
Tariffs.
Mike.
Tariffs.
All right, well, that seems clear. Before we get into the likely effects of the tariffs, maybe each of you could just sketch for me where you were before tariffs were announced. Chetan, let me start with you. What was your outlook for the Chinese economy before the latest round of tariff announcements?
Well, Seth, working with our U.S. public policy team, we were already assuming a 15 percentage point increase on tariffs on imports from China. And China also was going through some domestic challenges in terms of high levels of debt, excess capacities, and deflation. And so combining both the factors, we were assuming China's growth will slow on Q4 by Q4 basis last year from 5.4% to close to 4% this year.
Jens, what about Europe? Before these broad-based tariffs, how were you thinking about the European economy?
We had penciled in a slight recovery, not really getting us much beyond 1%. Backdrop here, still rising real wages. We had some tariffs in here on steel, aluminium, and cars, much akin, a bit more of a beefed up version, if you want, of the 18 tariffs, but not much more than that. And then, of course, we had the German fiscal expansion that helped our outlook to sustain this positive growth rates into 2026.
Mike, for you, you also had thought that there were going to be some tariffs at some point before this last round of tariffs. Maybe you can tell us what you had in mind before last week's announcements.
Yeah, Seth, we had a lot of tariffs on China, the effective rate rising to, say, 35 to 40%. But as Jens just mentioned, outside of that, we had some on steel and aluminum and autos with Europe, but not much beyond that. So an effective tariff rate for the U.S. that reached maybe 8 to 9%. We thought that would gradually weigh on the economy. We had growth at around 1.5% this year and 1% next year. And the disinflation process stopping, meaning inflation finishes the year at around 2.8 core PCE, roughly where it is now. So a gradual slowdown from tariff implementation.
All right, so a little bit built in, you knew there was going to be something, but boy, I guess I have to say, judging from market reactions, the world was surprised at the magnitude of things. So what's changed in your mind? It seems like tariffs have got to push down the outlook for growth and up the outlook for inflation. Is that about right? And can you sketch for us how this new news is going to affect the outlook?
Sure. So instead of effective tariff rates of 8 to 9%, we're looking at effective tariff rates maybe as high as 22%.
Oh, that's a lot.
Yeah, so more than twice what we were expecting. Obviously, some of that may get negotiated down.
And would you say that's the highest tariff rate we've seen in a while?
At least a century.
Okay.
So in terms of what it would imply for the outlook, if we were at 1.5% on growth before, it's pretty easy to revise that down, maybe even a full percentage point, right? So it's a tax on consumption, and a tariff rate that high is going to pull down consumer spending. It's also going to lead to even much higher inflation than we were expecting. So rather than 2.8 for core PCE year on year, I wouldn't be surprised if we get something even in the high threes or perhaps even low fours. So it pushes the economy, we would say, at least closer to a recession. If not, you're getting closer to the proverbial coin toss, because there are the potential for a lot of indirect effects on business confidence. Do they spend less and hire less? And obviously, we're seeing asset markets melt down. I think it's fair to describe it that way. And you could have negative wealth effects on the upper income consumers. So the direct effects get you very modest growth, a little bit above zero. It's the indirect effects that we're worried about.
Wow, that's quite a statement. So a substantial slowdown for the U.S., flirting with no growth, and then given all the uncertainty, the possibility that the U.S. actually goes into recession, a real possibility there. That feels like a big call. Jens, if the U.S. could be on the verge of recession with uncertainty and all of that, what are you thinking about Europe now? You had talked about Europe before the tariffs growing around 1%. That's not that far away from zero. So what are you thinking about the outlook for Europe once we layer in these additional tariffs? And I guess every bit as important, do you see retaliatory tariffs coming from the European Union?
No, I think there are at least three parts here. I totally agree with that framing. So first of all, we have the tariffs, and then we have some estimates what they might mean, which just suppose what we have heard last week sticks would get us already in some countries into recessionary territory, and for the aggregate euro area, not that far from it. So we think effects could range between 60 and 120 basis points of less growth. Now, that to some extent incorporates retaliation. And so the question is how much retaliation we might expect here. This is a key question we get from clients. I'd say we get something, that seems sure. At the same time, it seems that Europe weighs a response that is taking into account all the constraints that are in the equation. After all, the US is an ally also in security concerns. You don't want to necessarily endanger that good relationship, so that will for sure play a role. And then the US has a services surplus with Europe, so it's also likely to be a response in the space of services regulation, which is not necessarily inflationary on the European side and not necessarily growth impacting so much. But, be it as it may, this is going to be down from here for sure. And then the other thing just mentioned by Michael, there is clearly a read across from a slower US growth environment that will also not help growth in the euro area. So all being told, it could very well mean if we get the US close to recession, that the euro area is flirting with recession too.
Got it. Seth, can I interrupt you on this one? I just wanted to add the perspective on retaliatory tariffs from China. What we had actually originally built was that China would take up a retaliatory response, which would be less than proportionate, just like the last time. But considering that China has actually matched US reciprocal tariffs, it makes us feel that it's very unlikely that a deal will be done anytime soon.
Okay, so then how would you revise your view for what's going on with China?
Yeah, so as I mentioned earlier, we had already built in some downside, but with these reciprocal tariffs, we see another 50 to 100 bips downside to China's growth, depending upon how strong is the policy stimulus.
So at some point, I suspect, we're going to start having a discussion about what it really means to have a global recession. And markets are going to start to look to central banks. So Mike, let me turn to you. Jay Powell spoke recently. He repeated that he is in no hurry to cut interest rates. Can you talk to me about the challenges that the Fed is facing right now?
The Fed is faced with this problem where tariffs mean it's missing on both sides of its mandate, where inflation is rising and there's downside risk to the economy. So how do you respond to that? Really what Powell said is it's going to be tough for us to look through this rise in inflation and preemptively ease. So for the moment, they're on hold and they're just going to evaluate how the economy responds. If there's no recession, it likely means the Fed's on hold for a very long time. If we get negative job growth, if you will, or job cuts, then the Fed may be moving to ease policy. But right now, Powell doesn't know which one of those is going to materialize first.
All right, Mike, so I understand what you're saying. Inflation going higher, growth going lower, really awkward position for the Fed. And I think central banks around the world really have to weigh the two sides of these sorts of things, which one is going to dominate.
Exactly. Seth, may I jump in here? Because I think that's the perfect segue to the ECB, which I was thinking a lot about that. Just recently coming back from the US, how different the position really is here. So the ECB currently is on the way to neutral. At least this we have always thought as a good way of framing their way. Inflation is falling to target. Now, with all the risks that we have mentioned, there's a clear risk we see inflation going below 2% already by mid this year if oil prices were to stay as low as they are and with the euro appreciation that we have seen. The tariff scare in terms of the inflationary impact from tariffs, that's much less clear now whether that's really something to worry about, simply because what you typically see with these tariffs is actually a depreciation of the exchange rate, which we haven't seen. So we think there is a clear risk, downside risk to our path, or at least that we have an anticipation, a quicker rate cutting cycle by the ECB, and potentially if the growth outlook that we have just outlined, all these risks really materializes or threatens, is more likely to materialize, then the cuts could also be deeper.
That's super tricky as well, though, because they're going to have to deal with all the same uncertainty. I will say this brings up, to me, the Bank of Japan, because it was the one major central bank that was going the opposite direction before all of this. They were hiking while the other central banks were cutting. So, Chet, let me turn to you. Do you think the Bank of Japan is going to be able to follow through on the additional rate hike that you all had already had in your forecast?
Yes, Seth, I think Bank of Japan will have a difficult time. Japan is exposed to direct effect of 24% reciprocal tariffs. It will see downside from global trade slowdown, which will weigh on its exports, and yen appreciation will weigh on its inflation outlook. Hence, unless if US removes tariffs very quickly in the near term, we see the risk that BOJ will pause instead of hiking as we had assumed in our earlier base case.
Well, this is a good place to stop. Let me see if I can summarize the conversations we've had so far. Before this latest round of tariffs had been announced, we had thought there'd be some tariffs, and we had looked for a bit of slowdown in the US and in Europe and in China, the three major economies in the world. But these new round of tariffs have added a lot to that slowdown, pushing the global economy right up to the edge of recession. And what that means as well is for central banks, they're left in at least something of a bind. The Bank of Japan, though, the one major central bank that had been hiking, boy, there's a really good chance that rate hike gets derailed. Well, thank you for listening. And if you enjoy the show, please leave us a review wherever you listen and share thoughts on the market with a friend or a colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.